Good afternoon. This is Lee DiLorenzo, President of United Asset Strategies. I want to take a minute to thank everyone for joining us for today's webcast. This is the first of many broadcasts to come and a new format to accompany our quarterly newsletter. Sharing our economic views with you is an extension of our core values. It's our goal to keep our clients informed as to what's happening in the markets and with our investment strategies, using this form of program to deliver content. Today, we're going to take about 10 minutes to review important highlights from the first quarter of 2018 and share our views on the market and key factors that we are monitoring closely. This webcast is being recorded on Thursday, April 12th at 1:30 p.m. Eastern Standard Time. And please keep in mind that the material represents an assessment of the market environment at a specific point in time, and it is not intended to be a forecast of future events or a guarantee of future results. This information is intended for educational purposes only. So let's move on to the next slide. At United, we have built a team of experts who collaborate with respect to portfolio management and investment strategy. A screenshot from our webpage lists the members of our investment committee, and together we bring fundamental, technical, and quantitative expertise to shape our thinking. Today, as in 1992 when the company was formed, we remain committed to prudent, disciplined money management and believe in the importance of diversification. If you have not looked at our website recently, we encourage you to take a tour and get acquainted with our excellent staff. As many of you have heard me say, planning for a lifetime starts here. So let's move on to slide 3 and talk about the first quarter of 2018. After a smooth and steady upward trajectory that began really before 2017, we experienced an extremely strong January stock market performance. And as most of you are aware, it was a quick reversal with a return to meaningful volatility, and it has been taking place ever since February. For some perspective, there have been more than 1% daily moves in the S&P index in the last 3 months of 2018 than all of 2017. I'm just going to say that again a little bit clearer. There have been more 1% moves in the S&P this year than in all of 2017 combined. So as you'll see on the next slide, volatility is back. So let's take a little look closer to this return of volatility. During 2018, there have been 22 trading days that the S&P has moved more than 1%. And you'll see 6 days with moves more than 2%. If you compare this set of numbers to 2017, you will see that at no time last year did we see a single day with a 2% daily move. Many people reference the Dow Jones Industrial average, and when you quantify what is a 2% move, it equates to approximately a 500-point swing. So what does this mean for investors? It means hold on to your seats and buckle up because we're in for a bumpy ride. So to take us a little bit deeper, I would like to introduce Thomas F. Healy III. He's our senior policy analyst with United. He's also a portfolio manager, and he's constructed a meaningful new portfolio for us called Value Plus. So Tom, you're next.
Okay, thank you, Lee. As Lee has shown us, volatility has returned in 2018. The key drivers of this volatility include concerns around inflationary pressures, rising interest rates, and more recently, growing policy risk around things like trade, deficits, and regulation in the technology space. As we'll discuss later in the call, the economy has been getting stronger over the past few years, and this is good. But the flip side to that is this has led to an increase in inflationary pressures. The next slide shows us one of those areas, which is wage inflation. Over the past several years, we've seen wage inflation start to creep up. And this is concerning because as wages go up, this can impact company margins and therefore profitability. The Federal Reserve has a dual mandate to maximize employment while providing for a stable price environment. So when prices move up like this, the Federal Reserve will then seek to stabilize prices by raising the federal funds rate. This in turn leads to higher interest rates. This dynamic can be seen on the next slide. What we're looking at here is the 10-year Treasury note yield. After bottoming close to 1.5% in 2016, the 10-year Treasury note yield has increased to more than 2.9% in the first few months of 2018. While that yield has pulled back a bit in recent weeks, we do expect the Federal Reserve to raise rates a few more times in 2018. In the last few weeks, the biggest driver of market volatility, in our opinion, has really been around policy issues, and we discuss a few of those on the next page. One of those issues is the potential for a trade war. While there's been a lot of rhetoric from our administration and from leaders around the globe, what we're trying to do is differentiate between what part of the rhetoric is a negotiating tactic and what could possibly be implemented. Time will tell, but we'll be watching this closely. Another issue is the risk of government regulation in the technology sector. We've seen Mark Zuckerberg, the CEO of Facebook, in front of the Senate and the House this week, and there are growing concerns that this administration will seek to more tightly regulate the technology sector, which has been the highest growth sector in the economy for the past several years. Another risk is the growing federal budget deficit. The Congressional Budget Office released just this week its 10-year budget and economic outlook, and they're projecting that the federal deficit will exceed $1.1 trillion per year starting in 2020 and continuing through the 10-year period. This is due to a combination of lower tax revenues from the tax reform bill and higher spending from the recently signed budget deal. This needs to be watched closely. While there's always some level of geopolitical risk, currently it circles around heightened tensions with Russia, particularly with what's going on in Syria now, and also ongoing uncertainties around North Korea. And the last point I'd mention is it just seems that we're constantly bombarded by a steady flow of negative news coming out of Washington, which tends to create further uncertainty for investors. While we would concede there are valid concerns out there, there are also reasons to be optimistic. At this point, we see the plurality of economic data to be fairly positive. As you can see on the next slide, one of the things we're looking at is global PMIs. This slide shows the Purchasing Managers Index globally. This means the U.S., Europe, and Asia. I want to call your attention to the solid gray horizontal line at 50, because above 50 represents an expansion of both the manufacturing and service sectors. As you can see from this graph, the global economy is clearly in expansionary mode. And while it's eased back in recent weeks, the first quarter average of 54.2 represents the highest quarterly average since the first quarter of 14. We also look at a variety of other economic indicators in shaping our investment view. We're seeing positive things out of the areas like consumer sentiment, small business optimism, U.S. industrial production, and the employment indicators. Economic growth is important because there's a high correlation between the growth of the economy and the health of corporate revenues. And as we turn to the next slide, we can see that as revenue growth for corporations is strong, that also translates into very strong earnings growth. And as we look at 2018, right now, the consensus is expecting that companies comprising the S&P 500 will realize earnings growth of 19%, which is the strongest we've seen in 7 years. This is supposed to comprise of about 11% growth just from underlying health in the economy, and then also 8% from the tax reform bill. While earnings season is beginning in earnest next week, companies have already started reporting, and on average, they're beating the consensus estimate by 9%. We would expect that companies will continue to beat analyst estimates over the next few weeks. So we hope this provides some color on what we're seeing in the markets, and I'd like to turn the call back to Lee for her closing remarks.
Well, this does conclude our first quarter 2018 webcast for United Asset Strategies. We hope you find that the information contained in today's broadcast is helpful, and we encourage you to read our client letter for more details supporting what we've shared here today. This letter also includes a recap of our equity strategies, what their objectives are, and the changes that we've made in the past quarter. We'd love to hear your feedback on our new webcast and to answer any questions that may have come up for you today. Of course, you can reach us at 516-222-0021 or shoot us an email at info@unitedasset.com. On behalf of everyone here at United, thank you for giving us the opportunity to serve you with our broad range of investment capabilities and financial planning expertise.